Free Forex course by Bosun. Forex price charts. This is the fourth lesson in this free course. You can always come to my blog fxmarket360.blogspot.com for any update as per my post. Right, let's go straight to business. We need to know what price actually means in the forex market. When we talk of price in the forex market, we are referring to the standard of measurement of value of any given commodity in terms of money, and it varies with time. You're looking at the standard of measurement of value of any given commodity in terms of money. That's the monetary value of every commodity. That's what we call price, and this price varies with time. And this variation in price is because of the laws of demand and supply. Because we know that the higher the price, the lower the demand. The lower the price, the higher the demand. Conversely, the higher the price, the higher the supply. The lower the price, the lower the supply. Okay, so the force of demand is what drives prices higher, while the force of supply is what drives prices lower. When demand increases, prices of commodities will increase, and when price falls, when supply increases also, when price increases, when demand increases, then the prices will increase. When demand falls, prices will fall to ensure equilibrium. Right, so resistance levels on the chart is what represents the supply region. So whenever you see resistance on a forex chart or any commodity chart, that is the supply region. The resistance is the supply region. So in essence, it means this is resistance, this is supply region, this is resistance, supply region, this is another resistance, supply region. Okay, so resistance levels are the supply region in the market. Why the support levels are the demand, the support levels are the demand zones where we have buyers. Okay, so these are the support. This is support. We have buyers here. Buyers are concentrated here. Then here is also support. So look at it. This is support because the law is buy low, sell high. So you have buyers at the low, and then you have sellers concentrated at the highs. So these are the highs, resistance, where we have what? Sellers. That's supply. Sellers, supply. Here is the low. After fall to this low, and then we have demand here. That's buyers, and then we have demand here again. That's buyers. Okay. Currently, we are having a fall from a supply level. That's from a resistance level, and then the fall continues. We don't know where it's going to stop for now. Let's move on. So in essence, buyers are the agents of demand, while sellers are the agents of supply. Increasing buyers therefore implies increasing demand. When we have more buyers in the market, definitely it's going to drive price of goods, prices of commodities higher. And when we have more sellers in the market, it's going to drive the prices of commodities lower. So buyers are the agents of when we say buyers, they are the agents of what? Bullish pressure, while sellers are the agents of bearish or selling pressure. Right, now there are three types of price charts: the line chart, the bar chart, and the candlestick chart. I'd like to limit the scope of this lesson to the dynamics of candlesticks in the forex trading. Okay, for in particular for a special reason, because in the future we're going to look at every other part. Now, dynamics of candlesticks in forex trading. The two popular types of candlesticks are bearish and bullish candlesticks, and the anatomy, the parts of a candlestick is just OHLC, which stands for open, high, low, and close. If a candle closes at a higher price than its open price, then we say we have a bullish candle. But if it closes at the price lower than its open price, then it's a bearish candle. Okay, so now let's look at, before we look at some facts about candlesticks, let me briefly use chart to explain what I just said. Look at this red candle. You can give it any other color, but this is my own chosen color, red, for what? For bearish candle. You can see the level. It has open, high, low, and close. The open is 1058, while the close is 1019. So the close is lower than the open. So we say it's a bearish candle. This line is what we call high. This line is what we call low. You can also call it wicks. Alright. So this is a a bearish candle, which indicates sellers. Now, if you look at this one here, these blues, the blues here are the blue candles here are the bullish candles. So you see this one now, it opened at 1.1124 and closed at, it opened at 1.1071, and closed at 1.1124. So it closed higher. It opened at 1.1071 and closed at 1.1124. So that is a higher close. The close is higher than the open, so it's a bullish candle. And then you can see this high here and the low here. So anytime you look at the candle, you see it's open, it's high, it's low, and it's close. That's the major anatomy of a candle. Right. Now we talk about what drives the market and the anatomy. Now, talking about facts about candlesticks. A strong candlestick is the one whose body is longer than its wicks or shadows. It could be bullish or bearish. Now, the diagram below explains better. You see this this is a bearish candle and it's also a bearish candle. But the difference is that this one has high, that's wicks, high and low, that's wicks. But this one does not have. This is just a pure rectangular candle. So what's the difference? This is bearish, but this is a very strong bearish candle. This is a strong bearish candle. Similarly, these two candles are bullish candles. They open lower and close higher. Open lower and close higher. The difference is that this one has wicks, that's high and low, but this one does not. So this is a strong, very strong bullish candlestick, but this is a strong bullish candlestick. Now, so I say A, very strong bearish candlestick, B, strong bearish candlestick, C, strong bullish candlestick, and D, very strong bullish candlestick. Now, I want to talk about weak candlestick. A weak candlestick is the one whose body is very small compared to its wicks or shadows. It can be bullish or bearish, or just a pin bar. The diagram below gives us 9 examples of weak candles. You can see that all these 9 candles are weak candles. They are weak candles. Okay. Whenever any weak candlestick forms around its support, it signals a loss of bearish drive or loss of bearish momentum, and signals an inrush of buyers. What does that mean? It means if any of these weak candles here forms around a support, they are definitely signifying or indicating the end of a bearish move, the end of a fall, the end of a down trend or downswing, and now the beginning of an upswing or the beginning of a bullish rally. Okay, so that is what it means. That means when they form at a support, they are just telling us that we should be getting ready to sell, to buy, and closing our sell orders. Similarly, if a weak candlestick, as any of this, is formed around a resistance level, it also means that we have to close our, we're getting set to close our buy orders or protect them, just to protect our profit, and then be getting ready to sell. Okay, because it signifies a weak candlestick forms around a resistance level, signals a loss of bullish drive or loss of bullish momentum and an inrush of sellers. Okay, it simply signifies that it is sellers time. It is sellers time. Okay, in essence, traders tend to watch out for reversal or continuation whenever a weak candlestick is formed around a support or resistance. So whenever we have any of these weak candlesticks formed, if any of this candlesticks is formed at the support, then that means we should be getting ready to buy. And when any of them is formed around this resistance, that also means we should be getting ready to what? Sell. So that means sellers are entering the market already. Okay, so you can see it here. Look at them, they fill everywhere, almost at every turning point. This is a weak candle, we signal this sell. This is a weak candle, we signal this buy. This is another weak candle, we signal this sell. And this is another weak candle, we signal this buy. Alright, so whenever a weak candle is formed, it definitely signifies that there's going to be a change of direction. Okay, a change of prevailing direction to another or to the opposite direction. If the prevailing direction is down and we have this form at the support, that means we should be ready for a upward direction. And if it is upward and we have the prevailing direction is upward, and we now have this formed at the resistance, then we should be ready, getting set for a downward direction. So that's just it. That's just it. Just know that you must observe wherever where these things are, this kind of candles, this weak candle, any of them, wherever it is formed, it becomes very important when they are formed around a support or around a resistance. It may play no significant role really if any of them is formed far away from support or far away from resistance. Okay, right. I commend your commitment to success. Kindly subscribe to my channel and like this video. Please tell me something. Like my video, subscribe to my channel, and leave your comment about this video. If there's any question, please do not hesitate at all to ask me. The next video is going to be on trend. Please don't miss it. Join me in that video. Thanks and thanks and thanks again and again.